Hello everyone. I got so many requests to make a video on stock markets. Now, when you ask people what are stock markets, majority of people will say that they don't know how exactly they work, but they will tell you that you can make a lot of money there. So what are stock markets? It is a place where stocks are traded, right? But what is a stock? Well, it is a certificate of ownership share of a company. As you acquire more stock, your ownership stake in the company becomes more. But the main question is how they are created. Let's find out. Suppose I have a company which manufactures phones. My company is making decent profit with selling 100,000 phones every year. But suddenly, demand for my phones in the market increases massively up to 500,000 phones per year. So to manufacture 500,000 phones, I need more machinery, more manpower, all the other things more, and also more money to achieve the target. Let's say I need 50 crores for my plan. There are different ways to generate money for a company. One of the way is going to banks and take a loan. But that is not an efficient solution, as I will have to pay interest on the loan amount, and it also involves a lot of risk if it goes to loss. So the next thing is going to people and ask them to invest money in my company. Just like in the movie Guru, when Abhishek Bachchan says, we'll go to people and tell them to invest in the company.
हम जनता के पास जाएंगे और फैक्ट्री खोलेंगे। 10 रुपए दो और फैक्ट्री के मालिक बन जाओ। पब्लिक इशू, फैक्ट्री कमाएगी ना तो हम भी कमाएंगे।
Well, the thing is, can you directly go to people and demand for money, or do you have to follow the usual process? It can be done in both ways, but mostly the usual process is followed. About the first method, I will explain that in the later part of this video. If any company is offering stocks first time to public, then it is known as initial public offering or listing of the company in stock exchange. In India, the whole process is done under the guidelines of Security Exchange Board of India. So to create IPO for my company, first thing I will do is to go and hire an investment bank, such as Morgan Stanley, Goldman Sachs, etc. Why investment banks? Because they are the expert in the field, and the most important thing they do is underwriting of all my issuing stocks. That means they will take a guarantee of selling all the stocks of my company. So to begin official process, I will have to submit a registration statement to SEBI for approval for an IPO. Everything from this point onwards is done with the help of investment banks, such as creating red herring prospectus, which is nothing but all the financial records and future price range of the stock. To bring new investors, the company has to do a roadshow, and this prospectus is used during the roadshow. Doing a roadshow means they are promoting a company to new investors, where they will show them prospectus and convince new big investors to invest money in the company. This is done until I get the approval for an IPO from SEBI. Once the company gets the approval, the investment bank and company decides to create stocks and also decides pricing method such as fixed method or book building. So they create stocks according to the assessment of the market during roadshow towards my company. As my company needs 50 crores for its plan, and from the roadshow assessment, investors were interested in the price range of 400 to 600 rupees, then the stock price can be 500 rupees per stock with the issue of total 1 million shares. Let's say the price range interest from the investors during the roadshow was 200 to 300 rupees. Then the stock price can be 250 rupees with the issue of 2 million stocks. Once the investors get the stocks credited to their demat account on the day of IPO, the company is listed on the stock exchange. This process is quite long and tedious and takes a lot of time. So once my company is listed on the stock exchange, it is available for public to buy. During the IPO process, investment banks charge around 3 to 7% commission of the total value of the deal, depending on the size of the IPO. So with my IPO, they can make up to 3.5 crores. So the share price has to be determined very precisely by investment banks. For example, if the initial price of 1 million shares in IPO is priced at 500 rupees per share, but the shares start trading at 700 rupees 2 days after the IPO, this means the underwriter probably underestimated the demand for the issue. The direct result of this is my company collected only 50 crores when it could have possibly collected 70 crores, which also leads to less commission for the banks. In 2012, when Facebook's IPO was done, Facebook paid only 1.1% in commission to banks, but banks still made $176 million in commission. This is the reason investment bankers are so freaking rich. Investment banks make a lot of money because they sell companies for huge amounts of money while earning a generous commission and spending hardly anything in the process. What if a company wants to skip the investment banks and go directly to public? Yes, the first method I mentioned earlier in the video. In 1996, a company named Boston Beer Company was in a similar situation. The owner of the company, Jim Koch, did not want some random company to be its investor. So he made sure his customers get the best deal during the company's IPO and not the Wall Street bankers. He said, I wanted to give a chance to the people who had made Boston Beer the leading craft brewer in America. Usually, small investors like you and me get to buy the stocks only when they start trading on the stock exchange. So no company comes to us for any roadshow or any proposal for investing. To notify his loyal customers about the upcoming IPO of his company, Mr. Koch advertised on its beer bottles that the company is allowing small investors to buy 1 unit of 33 shares at $495, making it $15 per share. All the interested people just had to send in the checks to the company. He skipped the investment banks because, as I explained before, the normal IPO process is completely dominated by investment banks. And when an investment banker brings the new investor for the new company, they do a lot of favors to a particular investor depending on their commission to be earned. Mr. Koch felt that even though it is a public issue, there is nothing public about it. Also, the laws and the rules and regulations at that time were difficult for such kind of thing. As nobody has done it before, Boston Beer Company had sold its stock by both methods, directly to the public and through the banks as well. The stock price during the conventional IPO was $20 per share, and it was $15 through direct IPO. Mr. Koch had expected only 30,000 buyers for his direct offer. But the response was so massive, about 130,000 people had sent their checks to the company. In an interview, he said, "If I knew the response would be so massive, I would have sold everything with direct IPO." After that, considering this method of IPO, a model for modified Dutch auction IPO was developed. The same model was used by Google in 2004 when it went public. These kinds of IPO auctions are done very rarely, and it is against the interest of the banks because they take away their power over the IPO process. The IPO process is almost similar in every country in the world. It can have little changes here and there according to the rules of the country. I hope you liked the video. If you did, give it a like and subscribe. Also check out the sources in the description. And I will see you in the next video.